not a tax credit. It is instead related to RRSPs. So it is related to a deduction rather than a credit. But first, let's explain what it is. So the home buyer's plan allows you to withdraw money from your RRSP on a temporary basis. Uh, so it's not a deduction in and of itself. Essentially, it allows you to put money into your RRSP, claim a deduction for that money, and then make an interest-free loan from your retirement portfolio to yourself. The amount you can withdraw has changed somewhat over years. It used to be lower than this, but for 2024, taxpayers can withdraw up to $60,000 from RRSPs for tax-free, providing the taxpayer is a first-time home buyer and they have at least a written agreement to buy or build a qualifying home, and the purchase needs to be complete before October 1st of the year following the year of withdrawal. I'm not sure the purpose of the October 1st deadline, but it is quite specific. That would be 6 months after April 1st. I'm sure there's a reason that it's so specific about that, but I'm not sure what it is off the top of my head. An important caveat, though. Remember I said when you put money into an RSP, it needs to sit there a certain amount of time before you can get a contribution slip for it? There's a similar rule here. Funds that you put into the RRSP, if you want to withdraw them under the home buyer's plan, those funds need to sit in the RRSP for more than 89 days. In other words, the investment term for this is vesting. The funds need to sit there then for 90 days or more before you can withdraw them. So if you are planning to do this, you need to have it planned out in advance. You put the money into the RSP, you let it sit for 90 days, then this allows you to claim the deduction. And when you withdraw it, then that withdrawal will not be taxed at the time you withdraw it. This is different from other withdrawals from an RSP. Now, there's more examples in the text. If anyone wants, we can have a look at those. I do want to keep moving along, but I think you get the basics here. Now, let's have a little more detail. So, first-time home buyer. For this purpose, it's similar to what we've seen before, and broadly speaking, it's similar to the rules around the home buyer's amount. So the first-time home buyer cannot have lived in another home owned by themselves or by a spouse or common law partner, either in the year of purchase or any of the 4 preceding years. This rule is waived if the taxpayer or spouse has a disability or a disabled dependent, providing the home purchased is a more accessible dwelling for the disabled person. And again, a similar rule applies to the home buyer's amount. We're going to be talking about disability, but this is an important exception to be aware of. Now, they want me to mention that first-time home buyers can also qualify for some additional benefits that aren't, strictly speaking, part of the tax return. So, for example, if it's a new house, there's a GST, HST new housing rebate where you can recover some of the GST or the federal portion of HST for a new home or a substantially renovated home. But that is separate from the income tax process. So be aware of it. Clients may ask us questions about this, but it is separate. So it's going to be aware of it, but it's technically separate from the income tax process. It's a sales tax refund, not a tax refund. And there is an exemption from the first-time home owner rule if a spouse or common law partner separate, if there's a separation of at least 90 days, but the exemption doesn't apply if the taxpayer turns around and then moves into a principal residence owned or occupied by a new spouse or common law partner. So there are some complicated. Now that's a good question. Should the disabled person be the owner of the new house? So no, it can be a dependent. So for example, if you have a disabled child and you buy a new house that better accommodates their disability, then you would qualify. So you yourself, the owner of the house or their spouse, does not themselves need to be disabled, but there does need to be a disabled dependent, a child, an elderly relative, or so on. Now, as I mentioned, the home buyer's plan, you can think of it as an interest-free loan from your RSP portfolio to yourself. You do have to repay your plan. If you don't repay it, then the government considers this as just a regular withdrawal. It's like, aha, this person just took the money out and kept on it, so we're going to tax them on part of that money. So you have to repay your RSP beginning the second year after the withdrawal, and it is spread over 15 years. If you're repaying, you have to repay a plan belonging to to yourself. So you can't withdraw from your plan and repay your spouse's plan, for example. They have to go to the original taxpayer's plan. It doesn't necessarily need to be the same financial institution. And that's a general point for RSPs and TFSA. Your contribution room, your deduction room is not per bank, it is per taxpayer. So I can have RSPs in more than one bank. The deduction room is for my total contributions for the year. And so I can withdraw from one RSP at one bank and put it into a different RSP or even a new RSP in another bank. That's perfectly fine. Now, the repayment is done on a year-by-year basis. So for every year, the government takes the amount that is owing and divides it by the number of years remaining so that you are paying, it's equally spread over the following years. So there's no interest per se. So this also means there's no particular advantage to paying it back more quickly because it remains interest-free, other than, of course, having that money back in your RSP will allow it to be earning investment income. Now, because the home buyer's plan amount contribution limit, which remember 60,000, right? Remember 60,000 withdrawal, that recently went up, and the government, in order to reflect that, say, oh, okay, if you did this a year or two before, you didn't have this your limit was lower. We recognize that's a little unfair, so they brought in some temporary repayment relief. So if your first withdrawal is between 2022 and 2025 in those years, then there's a deferment to the start of the 15-year repayment plan by an additional 3 years. So for those people who withdrew in this year and the previous 3 years, they get an extra 3-year deferral. So those repayment plans will start the 5th year following the withdrawal. So for example, if you withdrew in 2024, your first year of repayment is in 2029. But this is a special exemption. This is a temporary thing. The base repayment period start delay is going to be 2 years. Now you can start repaying sooner. It's what we're talking about are mandatory repayments, required repayments. Now, another thing about the home buyer's plan withdrawal, when you withdraw from your RSP for the home buyer's plan, you need to file the correct paperwork with the bank. You can't just take money out of an RSP and buy a house with it. You need to tell the bank you are making a withdrawal under the home buyer's plan. If you do that correctly, then the withdrawal will be reported in box 27 of a T4 RSP, and then you can be entered in Schedule 7 as a home buyer's plan withdrawal. If you don't do that, and it's just a regular withdrawal, then you have to pay tax on it immediately. So it's very important to file the correct forms, and if necessary, speak to the bank. If they put out the wrong form, see if you can get them to reissue the T4 RSP. Now, while you're repaying your home buyer's plan, you have to file a tax return every year. This is one of the reasons to require people, one of the conditions which requires people to file a tax return even if they don't owe any tax. And if they don't repay the home buyer's plan amount for that year in a year, if they don't make a full repayment, then any difference, that difference is just treated as it's added to income. It's just treated as, oh, we're going to retroactively treat this portion of it as a regular RRSP withdrawal, and it's added to income on line 12900. Okay. Oh, question. So so Muhammad asks, if my grandmother is disabled and living with you, and you bought a new house for her accessibility issue and want to facilitate her, can you claim this benefit in this situation? Yes. Right? Assuming you haven't bought the house yet, you can so you can claim the home buyer's amount and you can withdraw under the home buyer's plan. Right? You can't do it retroactively. So you need to, at least for the home buyer's plan, so if you haven't bought the home buyer's amount, you can go back and claim for that reason. There are other benefits you can claim around disabled dependents. So we're going to talk more about that when we get to dependents and to disability later on. But yes, at a first cut, providing you file this paperwork before you withdraw from the RSP and buy the house, then yes, you absolutely could. If your mom or grandmother was disabled and the new house you're buying is more accommodating to their disability, right? You have to live in it though, right? It needs to be one you reside in. It has to be your primary residence. But lots of people are looking after an elderly relative and would qualify. Now, what makes someone a dependent or not, we're going to talk about that in a future class. But there are other conditions which need to be met. But as a general note, yes. Now, a similar provision exists for people who want to withdraw from their RSP to fund their further post-secondary education. So you want to go get some job retraining or things like that. So you can withdraw up to $10,000 in a calendar year from an RSP to finance either your education or that of your spouse or common law partner. It is limited. It's a maximum of $20,000 over 4 calendar years. And this withdrawal is reported, again, you need to file the paperwork correctly with the bank, so they issue the correct T4 RSP slip, and it'll show up on box 25 of the T4 RSP, and it's entered on Schedule 7. Mechanically, it's very similar to the home buyer's plan, although the limit is lower, and as you can see, it's limited by 4 calendar years, which roughly corresponds to the period of time to complete a degree. But otherwise, it's quite similar to the home buyer's plan, and the same general rules apply, except that instead of a qualifying house, it needs to be a qualifying educational program. So it needs to be at least 3 months duration. You need to enroll in such a program before March of the following year. And again, the funds need to they need to vest in the RSP for more than 89 days before the withdrawal. And once you make a withdrawal and start to repay it, you have to file a tax return every year. And if a less than full repayment is made, then the difference is added to income. For the lifelong learning plan, the repayments start in the 5th year after withdrawal. So assume you go to college, it's a 4-year degree program, your initial withdrawal will be first year. So the 5th year after withdrawal, assumably you've completed your degree by then, that's when you start to repay. If the program is shorter than 4 years, you may have to repay earlier. If you drop out of the program, you may have to repay earlier. Now, unlike the home buyer's plan, repayments need to be made over 10 years. Uh, Again, the amounts, generally speaking, are lower than those for the home buyer's plan. And repayment, again, must be made to your own plan, not a spouse or common law partner's RSP. Now, previously, we talked about the Schedule 7. Just to review it, we're going to talk about it a little more, just to go over it again. So Part A is where we have the contributions that we make. Part B is where you put in your repayments under the home buyer's plan and the lifelong learning plan. Part C is where you calculate the deduction that you can make and or are choosing to make for the current year. In Part D is where you have your unused contributions that you're going to carry forward. Part E is where there's any new withdrawals under the home buyer's plan, lifelong learning plan, and Part F for amateur athlete trusts. Amateur athlete trusts, not very common. They just fall under the RSP rules, so we need to mention them because they're on the Schedule 7. Okay, so let's have a look at these in a bit more detail, a little more zoomed in. Okay, so Part A for contributions. Again, as we see, again, the unused contributions from the notice of assessment are put in first. Then we have contributions to your own or your spousal RSP in the first contribution period, and then similarly the second contribution period. They're all added up, and this gives us the total contributions on line 5. Now, important point to note here. Part B is when we put in the repayments under the home buyer's plan and the lifelong learning plan. So your total contributions come in here, line 6, and then you designate how much of that, if anything, you're going to designate as a repayment under the home buyer's plan and or lifelong learning plan. So you deduct the repayments, and then that leaves you your contributions. Now, notice the important point here is that these repayments are deducted before the contributions are compared to your deduction limit. In other words, your deduction limit does not affect your ability to repay the home buyer's plan and lifelong learning plan. Your deduction limit can be 0, and you can still repay the home buyer's plan and lifelong learning plan. And philosophically, this makes sense because these already came in under a previous deduction limit. You're just putting the money back, right? But this is an important thing to be aware of. The deduction limit doesn't affect your ability to repay the home buyer's plan and lifelong learning plan, and that means you can continue to repay these after you turn 71 and do not have any more deduction room. And Gurjinders asks, the unused contributions are the amount from the notice of assessment. Yes, that's right. I believe it even says so on the form. Going back here. It lists the notice of assessment or a form T1028. You don't need to worry about that form, but just be aware that it might appear on an alternate form. But at this level, we're just going to worry about notices of assessment and reassessment. In Part C is where we calculate the deduction. And again, the key point is we bring in the deduction limit here. If there's any employer contributions to a PRPT, they're deducted, but that's not going to apply in most cases. So we look at the contributions available to deduct from the previous page. Notice there's a line here of what are called transfers. We're going to talk about those in a future session. Don't worry about it for now. Just note in passing. Transfers are when you can make contributions to an RSP which don't take the deduction limit into effect, right? But we're not going to talk about that right now. Just make a note in passing. But here, the amount of your total contributions or the contribution level, the contribution limit, right? Whichever one is less is what you put here, and that's what you can deduct. And then line 18 is what you are deducting. So again, that is discretionary. You can decide how much to deduct, how much you want to take off. Part D, it's very straightforward. Anything you didn't deduct previously comes forward. So you take the contributions available to deduct, you deduct, you deduct what you chose to deduct, and this leaves you the unused contributions you can carry forward to a future year. And then it just so it says right here, these are going to be shown on your 2024 notice of assessment. Then Part E is where new withdrawals under the home buyer's plan or lifelong learning plan are noted. There's just a couple extra things here. So if your address on the return is the same as the home you purchased, tick that box for informational purposes of the CRA, and tick this box if your spouse or common law partner is the student that you withdrew the funds for under the Life LLP. And you can only make this designation the year you make your first withdrawal under the LLP. If you don't tick the box, you're considered to be the student for LLP purposes. So that's a subtlety to be aware of there. And again, lastly, Part F, contributions to an amateur athlete trust. All you're doing is declaring how much money was contributed to the trust. It doesn't have any particular effect on the tax return. All right, now one last thing we're going to talk about before we get to the break is something called a first home savings account. And it is, as you're going to see, it has some similarities to RRSPs, but it's much more targeted. So this was a provision that began in 2023. This is a special type of registered plan which is only allows taxpayers to save money to buy or build a home. The year you open an FSHA, the participation room, there's a spelling error. So the participation room is $8,000 in the year you open it, and you have a lifetime limit of $40,000. And you must fill out Schedule 15 to track your limit and any carry forwards and deductions that you make. So using Schedule 15, you can calculate the deduction you can make, and then it is deducted on line 20805 right after the RSP deduction. So, as I say, FHSAs are quite new. They only came in 2023, and they came in, I believe, April of that year, so halfway through tax season. So we saw a couple that year, and we've seen more the following year. A lot of people are unaware of them, but they are a useful supplement to the ability to use the home buyer's plan. So as you can see, between the FHSA and the home buyer's plan provisions, people now have the ability to put up to $100,000 away into a registered plan to help save for that first house. Now, with the FHSA, things to bear in mind. There are no spousal accounts or plans, no such thing. And the contribution period is the calendar year, full stop. So any contributions you make to the FHSA have to be made in the calendar year to be considered in the calendar year. Now, because the FHSA is specifically dedicated to buying a first home, it's not like an RSP. It's not a retirement plan where you're going to need it when you retire. Conceptually, it is dedicated to buying that first home and nothing else. So when you make FHSA withdrawals, they do not need to be repaid. Thus, once you purchased a home, then there's no need to repay the plan conceptually, right? There's no need to repay it because you've purchased the home and you only get to do this once. So there's no need to pay it back because the plan no longer will exist. And on that note, I think we're ready to take a break. Right. Any questions? Oh, previous slide, Karina? Sorry, which one? Sorry, Karina, what did you want to see? The FHSA? Right, so, right. What would you, what did you have a question about? I just got a question. For the FHSA, how long does the money need to be in the account before withdrawal? You know, that's a very good question. I do not know if it has the 90-day vesting requirement. I think, yeah, I don't know. I would have to look into that. If you're thinking of doing this, the bank would know, however. So when you talk to the bank, they'll be able to tell you. I would think there is that requirement, but I can't say for certain. And for carrying forward, your carry forward, well, let's have a look at Schedule 15. Or, you know what? Hang on. Let's take a break. And then after the break, we'll look at Schedule 15. You guys are just trying to work too hard and not have a break. All right, so let's take a break. And then after the break, Schedule 15. All right, so let's pause recording and we'll pick it back up in 15 minutes. All good, Doreen? There we go. Okay, welcome back, everybody. All right, so as I said before the break, we had some questions about Schedule 15, I think. So let's have a look at that, just briefly, though, and then we'll get back into talking about other types of registered plans. So for Schedule 15, the important thing to bear in mind with, no, not that one, the Schedule 15, not the 5015. Okay, all right. The important thing to bear in mind with FHSAs is that they're still very new, right? They only came in 2023, so a lot of people are not going to have a lot of contribution room necessarily. But the general shape of the form, pattern of the form, is basically similar to Schedule 7, just a little more simple. So the first page has instructions. Step 1, you indicate if this is the first year you opened the FHSA, and then your contributions, if any, will be made on what's called a T4 FHSA slip. And then if you made any contributions after making a withdrawal from the plan, and then there will be an FHSA limit on the notice of assessment, right? So just like RSPs, this limit is going to be on the notice of assessment and updated yearly. Now, unusually, contributions to and withdrawals from an FHSA are made on the same form, the T4 FHSA. And in any given year, currently $8,000 is added to your limit to give you the current limit carried forward from previous years. It is possible to transfer amounts from RSPs to FHSA, so this is all calculated together to figure out what your limit is for the year. And then again, it follows the same pattern. You calculate the maximum deduction you have available, and then you can choose to deduct that amount, and that amount is deducted in line 20805. And if not, it is carried forward. Now, and again, just like with an RSP, if you have an excess amount or otherwise you had trouble, then you might not be able to claim this in a future year. But otherwise, it seems to have the same general pattern as an RSP. It can carry forward, most likely indefinitely, just as with the RSP, providing you have room to claim it. So, and you didn't exceed your FHSA deduction room. Now, what I don't know is if it still has the $2,000 overshoot that we see with RRSPs. But in general, information can be found on the CRA website and in the textbook. Again, because FHSAs are so new, you might well have questions beyond what is in the textbook, and in which case I would suggest having a look at the CRA website. Okay. On that note, let's get back into our main topics. So we're going to talk about two other kinds of registered plans tonight. So the first is the registered disability savings plan. These are intended to provide long-term security for a disabled person, either the taxpayer or a dependent. Generally, these are initially set up by a parent or a guardian or other family member to protect the interests of the disabled individual, and there are matching grants and bonds available from the federal government. This is the main benefit of these plans because contributions to an RDSP are not tax deductible. But depending on the grants and bonds you get, these can, I am told, that these can be up to 100% of your contributions up to a certain level. So essentially the government will match contributions up to a certain point. Now, contributions cannot exceed $200,000 in a beneficiary's lifetime. And when money is withdrawn from the RDSP by the beneficiary, any payments which comes from investment income for bonds or grants or things like that, that is taxable in the hands of the recipient, but only when it's withdrawn. So again, as with an RSP, the income earned while money is in the plan is not taxed until it is withdrawn. Oh, question. Benicia asks, for the home buyer's amount, there's a 5-year period before you can qualify again after buying your first home. Is there a similar waiting or reset period for the FHSA? As I was saying, these are very new, so there hasn't been time for that to come into effect. My understanding, though, is that this is a once-in-a-lifetime thing. And given the timescales involved with the home buyer's plan as well, it may simply not be practical to do this more than once in a lifetime. But I will double check that because it may simply be that it is once in a lifetime, or it may simply be that these are so new that they haven't had a chance to set up rules around that yet. As a practical matter, I think the government is thinking that people are not going to be doing this more than once. Again, they're very new, so we watch for developments. All right. Another kind of registered plan, which is quite common, is what's called a tax-free savings account. Now, these are quite different from what we've discussed previously, although they are, again, a type of tax-sheltered plan. So these are open to residents of Canada, 18 and over. They started in 2009. The initial contribution limit was $5,000, and then the contribution limit for every year that goes by, the contribution limit grows. So once you turn 18, contribution room automatically opens up every year. Currently for 2024, it is $7,000 is added in. Now, with a TFSA, there is no tax deduction. You do not need to file a tax return to create contribution room. It just happens automatically. It's not pegged to your income. It is pegged to your residency, so you need to be a resident of Canada. But you don't need to file a tax return just to build TFSA room. Conceptually, you can think of TFSA contributions as post-tax income. The post-tax money, the money you put in a TFSA has already paid tax, so it goes into a TFSA. You don't get a tax deduction for it, but at the same time, when you withdraw from the TFSA, you don't have to pay tax on it. So there's no tax deduction, but the TFSA money from the TFSA is entirely untaxable. So any investment income, any growth in the plan is also not taxed. Your unused contribution room is carried forward, so this is why it grows by a certain amount every year once you turn 18. And any withdrawals you make from a plan are added to your contribution room in the following year. So let's say your contribution limit is $20,000, and you have $20,000 in the plan, but you withdraw $5,000, then that'll open up $5,000 in the plan next year. It's important to understand, and some taxpayers have trouble with this, that this doesn't happen immediately. In investment terms, TFSAs are not what's called a flow-through account. If you withdraw from the plan, you will get room, but you don't get it until the next calendar year. If you, as with RSPs, if you make excess contributions, there's a 1% per month penalty. And if someone was 18 in 2009 and has been a resident of Canada the entire time since then, their maximum contribution room now, therefore, would be $95,000. So initially it began at $5,000 a year, then it got bumped up by a certain amount every year, and currently $7,000 to come out with $95,000 total. If you want a full breakdown of the contribution limit each year, it's in illustration 8-20 in the textbook. But essentially, in most years, the rate would stay the same or go up in increments of 500 if inflation had been high enough. All right. So any other questions about TFSAs before we move on? The main things to remember is that TFSAs do not allow you to claim a deduction, but they are still sheltered from tax, at least somewhat. So you cannot claim investment expenses against them, just like with other registered plans, other tax-sheltered plans. All right. So one more poll question. We'll just pull this up here. And then we will get to our chapter review problems. Let's see how well you were able to absorb everything up to this point. Set our time limit. So RSP and FHSA deductions, if you claim them on the tax return, blank. All right, so which of these four options? Do they lower total income? Do they lower net income? Do they lower both net and taxable income? Or do they lower taxable income early? All right, let's see what you think. All right. WebEx is just going to give a few seconds to tally the results here. All right, let's share the results. So the correct answer is C, and most of you got that. So remember, these deductions, for RSP deductions, they happen at line 20800. So this means after total income has been calculated, so total income is unaffected by this. They give a lower net income, and if you have a lower net income, you will also have a lower taxable income. So the correct answer is C. Any deduction that happens in step 3 of the return will give you a lower net income, and anything that gives you a lower net income by definition gives you a lower taxable income. All right. On that note, let's move on to our chapter review problems. Does anyone have any questions before we do? All right then. So in that case, we've got about 45 minutes left, so I'm going to spend about 15 minutes on each chapter review problem. And from this point forward in the text, we're not requiring you to complete the entire tax return, but rather only enough of the tax return to answer some questions. So I'm not necessarily going to go through the tax return line by line. If you have key questions, encourage you to. As just a reminder, we will be going over assignment 1 after we do chapter review problems 8-1 and 8-2, but that part is not going to be recorded, and so we're going to be doing the other things first. All right, so, about 15 minutes each, I think is what we'll aim for. Okay, so that said, chapter review problem 8-1, let's have a look at the problem. So there's some key points, key questions we've got here. We'll go through one by one. But first, let's pull up the problem, have a look at that. So, close our polling window. There we are. Okay, so our first one is for Maria Perez. And Maria is single. And she was living at Harmony Road in Georgetown in British Columbia until she found a new position in New York City. And then on April 1st, she started working as a photographic designer for Still Life Limited at Patricia Drive in New York City. On March 29th, she moved from Georgetown to New York City. She paid $370 to rent a U-Haul trailer, drove 348 kilometers to her new home, and purchased one meal while on the road. She canceled her lease. She paid a $650 penalty and bought a new home at 61 Trillium Court in New York City. All right, now she owns the home that she's purchased. She was renting previously. Notice that she will not qualify for the British Columbia Renters Tax Credit as a result. She's not renting the minimum of 6 months. The home costs $220,000, and she paid $1,500 in legal fees. Now she withdrew $35,000 from her RSP under the home buyer's plan for the down payment. She's very excited about the move. This was the first home she has owned. Her new residence is 5 kilometers from work, and the old residence was 350 kilometers from the new work location. Home wasn't ready for occupancy right away, so she had to stay for 7 days at the Shady Rest Motel and purchased meals and restaurants during the 7 days. She received a token moving allowance from the new employer, and it was not included in income. Now, prior to finding this job, she was unemployed, but she does have income from a mortgage arising from the sale of a family property which she inherited. The mortgage interest she receives for the year totals $5,106, and she invested this in a TFSA. She doesn't have an information slip for the income, and she doesn't want to report it on her tax return. Then we have her T-slips. She's a Canadian citizen, doesn't live within a CMA. Okay, so her T4 from Still Life Limited, and we can see her income, 36,325, and no unusual boxes here, no union dues, RPP contributions, and so forth. The income tax deducted, of course, we take from down here. So for box 22, it's 4333.95. However, she also had some income from employment insurance. So her T4E lists 4108 in regular or other benefits paid with a repayment rate of 30%. And notice that 10% has been taken off in income tax. So we need to take this into account for our calculations. The T4 RSP shows the home buyer's plan withdrawal, and it must have been filed correctly because it's showing up in box 27. There's no spouse involved, so no to that box. All right, so we're going to answer the questions and then look at Maria's T1M. All right, so questions are down here. You can fill them out as they go, but we will go through them on the slide. Slideshow. All right, so first of all, is she eligible to deduct moving? Get back here. Is she eligible to deduct her moving expenses? Why or why not? So now, if you have to answer why or why not, remember there are conditions you have to meet in order to claim moving expenses. So number one, it's more than 40 kilometers closer to the new job. Number two, the purpose of the move is a new job. And another one, it also is a genuine change of address, a genuine move. She's not moving to temporary housing or anything like that. Now, that seems obvious, but there are cases where someone is moving to a work camp or just goes to work for a fishing lodge in the summer or things like that. So the third one is subtle, but it also applies. That, for example, is one of the reasons why many students may not qualify for moving expenses, even if they are working. Right, now, are any of the moving expenses ineligible? And if so, why? The cost of purchasing a home and the associated legal fees cannot be claimed. Right? The legal costs for the new home are ineligible because you didn't have to sell a home as a result of the move. Right? And the actual cost of the home itself is also not an expense. That is a capital outlay. So that would be factored into the potential capital loss or gain when she actually sells the house. So it cannot be claimed under this provision. The legal costs could be claimed as a capital expense when she sells the home, but again, they cannot be claimed under this provision. Now, the $500 she receives from the employer, well, let's get to that question. Let me make sure I didn't miss anyone's question. But I think we covered everybody. And Doreen, let me know if there's any questions I miss as we go, right? Thank you. Just keep an eye out. So, does she have to include the $500 moving expense allowance from her employer in her income? Okay, so this is a subtlety that's important to understand. And conceptually think about it like this. So the employer, when they issue a non-taxable moving allowance like this, right? It's not included in income. It's not on the T4. It's not a taxable benefit in Box 40. When this happens, what essentially is happening is the employer is paying for something, right? This isn't income. The employer is paying for something. Maria doesn't have discretion over what to spend the $500 on. Really, it has to be on these moving expenses. So it's not included in income. Instead, it is deducted from what she can claim for the expenses. And the reasoning is the employer just paid for $500 of it, so she didn't pay for it. The employer did, so she can't deduct what the employer paid. And because the employer pays for it, and the employer pays for lots of things, it's also not included in her income because it's an expense for the employer, not her. The employer could claim it on their taxes essentially, but that's another story. All right. Now, Karina's got a question. Can expenses be claimed for personal moves? As we touched on when we talked about moving expenses, and this is a good question in case anyone missed our discussion when we talked about moving expenses, and anyone who's downloaded this and is listening to it online, may have missed this discussion. Remember the principle that in general you can only deduct something for income tax purposes. You can only make a claim for income tax purposes if it relates to income in some way. So moving expenses for a personal move are not going to be claimable because they're just personal expenses. They're not related to income in some way. And this is why the purpose requirement applies to moving expenses. It has to be for work or to carry on a business or to earn income as a student, essentially. And if none of those apply, then it's just a regular life expense. It's not done to earn income, and so it can't be claimed. Now, if there's some provision where the move is related to income in some way, normally it would be for business, and that is explicitly allowed, right? But other kinds of moves for health reasons, for example, are not claimable under this provision. As we will see, certain moves for reason of disability, you can claim some expenses for that, but those are not done under this provision. But we'll talk about that when we get to health and disability. Yeah, so in general, a personal move where there's no particular reason for it that has to do with income and no one is disabled, then it can't be claimed. Now, can she claim the legal expenses? I think we talked about this. The legal expenses are related to the purchase of the house, and she didn't sell a house as part of the move, as a result of the move, so she can't claim them. They could be factored into her capital gains calculation when the house is eventually sold, but that's not a moving expense. All right, now, does she have to include the $35,000 RRSP withdrawal in her income? It's not going to be included in income immediately because it is essentially being borrowed from her retirement portfolio. She has to pay it back, and if she doesn't pay back the required amount in a given year, then that required amount will be included in income. But otherwise, it's by default not going to be included in income. Remember, and notice the key point is she has an RSP form which shows this withdrawal as being made under the home buyer's plan. Pardon me. Does she have to repay? Oh, does she have to report the mortgage interest she received? Good. So even though there's no T-slip associated with it, because it's a private mortgage, there's no financial institution involved necessarily. It is investment income, essentially. It is interest income. So she does have to report it. And again, she pays tax on the mortgage interest, and then what she puts into the TFSA, after that point, any interest it earns is going to be uh, tax-free. Good. So exactly, Grant. Money that goes into a TFSA has by definition already had tax paid on it. Okay, and she has to report it. In other words, it is considered income, right? In YECA, you're exactly right. It is considered income. Does she have to repay her EI benefits? Now, you're right. She doesn't have to repay them. Box 7 does have a 30% repayment rate. So potentially, she might have to repay them. So they are in box 15, and they are subject to a 30% repayment rate. But remember, there's an income threshold. So if your income, your net income, is less than, roughly speaking, your net income is less than 79,000 for the year, and her income is well below that. So her income is below 79,000, so she doesn't have to repay anything. So remember, there's the two components there. Is there a repayment rate? Is the income in box 15? And even if it is the total net income for this, is the net income for this person above 79,000? And it's not, so she's in the clear. Now, how much can she contribute to her TFSA in 2025 if the contribution in 2024 was her first? So for this, you would need to figure out what her contribution, what her TFSA room was. So for so for 2024, right? So just to, sorry, I'm just going to go a little quickly here, but so it starts at 95,000, then we deduct the amount that she puts in to the TFSA, 5106, and then we add 7,000 for 2025. So the final figure would be 96,894. Right? So it starts at 95,000, and then we deduct the 5106. So that equals 89,894. Did I get that in? 89,894. Then add 7,000. And that gives us 96,894. Is that okay, Mohammed? Have you got it? Okay. And what non-refundable tax credits can she claim? So just the basic ones: the basic personal amount, the CPP contribution, the EI premiums, the Canada employment amount, and the home buyer's amount. So those are the big ones. All right. For preparing the tax return, we're going to touch on highlights and then the questions. The main thing we're going to highlight are the T1M. So we're not going to look at the whole return, particularly tonight when we want to keep an eye on our time. So let's pull that up though. And hers is Maria's should be. There we go. Maria's there. So let's have a look at her T1M. So again, and remember with T1Ms, I'm going to need a AI summary of that. Right, so the first 3 pages are instructions. Again. So let's look at her form. I just want slightly bigger. Okay, so right, so we can see first we do the distance calculation to see if it meets the distance requirement. 350 kilometers minus 5 is 345, and that is more than 40 kilometers, so it meets the distance requirement. The date of the move is reasonably close, so it meets the reasonable time requirement, and the reason for the move is to work, so it meets the purpose requirement. Then the address is a genuine move, so new address and old address. So parts 1, 2, and 3 are all reasonable. Then we calculate the moving expenses. So transportation and storage costs, it's our old friend U-Haul, so she claims $370 there. Then during the move, she's using the simplified method. So $200.10 in travel expenses. So again, that's 348 kilometers times the British Columbia per kilometer rate. She eats 1 meal while on the road. That's $23. So that's $223.10 in travel expenses. Then in the new place, she has to stay in the hotel for 7 days. So notice she claims the actual amount from the hotel receipt, $455. But for the meals, 7 times 69 gives us $483. So a total $938. She's able to claim the cost of canceling the lease of $650. So we add in $650 there. So the rate per kilometer, again, is based on the province of departure. So for British Columbia, for the applicable year, it is 57.5 kilometers, 57.5 cents per kilometer. This amount will vary by province and by year. So when you are calculating moving expenses, if you're doing it manually, you need to check and make sure that you're using the appropriate rate for that year. And this can be found if you just search for moving expenses on the CRA website, and then look at the simplified method. It will take you to a link of all the rates. It can be found other places too. That's just kind of the easiest one to remember. Right. There's nothing about selling the old home or buying the new home which can be claimed here. So then her total moving expenses, $2181.10. We deduct the $500 from the employer, and this leaves net moving expenses of $1681. And this is, of course, much less than the income she makes in the new place, and so she is able to claim the entire $1681.10 in the year. Okay, that's fairly not too bad. Where we? Oh, we got about 25 minutes left. So when we do a tax return for somebody, right, we always want to go through and check, make sure that it makes sense. So, we want to go through, look at the final result, see if it makes sense. So, does it make sense to you guys, the tax return? What the result we should get, by the way, So typically we answer that question, does it make sense, when we look at the bottom line. So if we look at for Maria, scroll way back up to the top and have a look at her main return. The question which we'll want to know is, does the final result make sense? Because that's what it boils down to. Does the final result make sense? Is she claiming things that make sense? Does everything fit together? So in her case, wish Adobe made it a little easier to navigate. All right, so she's getting a refund, right, of $1,218.66, and we can say that this kind of fits with what we would expect. So she's got her moving expenses. So this reduces her taxable income by that amount. So that would produce some of the refund. We can also see there's a CPP overpayment, which also generates part of the refund. And although she has EI, which is undertaxed, that EI is relatively small, and it is paying still 10% tax on it. The other thing which might come into play is that because she's only working for part of the year and her income is high enough that the employer might be taking off income tax at source as if she was working for the entire year. So if she had worked for the entire year at that rate, she might have had to pay tax in a higher bracket. So the employer might have been taking off more tax than you would expect for someone who's just going to be in the bottom tax bracket. So your provincial or territorial credits, and again, so the non-refundable credits are claimed on Provincial Form 428, and the refundable credits are claimed on Provincial Form 479. There aren't any in this case because the only ones which could apply would be the BC sales tax credit, and her income is more than $18,000, and the BC renter's tax credit, but she wasn't renting a minimum of 6 months, so that also wouldn't apply here. Okay. And again, just a reminder, although federally the home buyer's amount can be claimed as a tax credit, way back up here, yep. When we look at her BC 428, it's important to remember that there's no provincial home buyer's amount, right? So her provincial tax is going to be a little bit higher, relatively speaking, than the federal tax, because that federal tax has that extra amount which can be claimed, and her income is too high to qualify for the BC tax reduction. Okay, all right. Time-wise, it's 20 to 9. Guys, I think you were pretty busy over the break working on the assignment itself, so I think some of you might not have finished 8-2. So I'm just going to go over the problem very briefly, and then we can look at it in detail at the start of next class. But for 8-2 then, because again, I suspect some of you haven't finished it. So this is for Darren Leduc. He's divorced. He's collected some WCB benefits, and he's had a lottery winning and has put some of the money into his RRSP, and he has the deduction limit there. And he owns a property outside Canada. So the property was inherited in 2020. The fair market value was 92,000 Canadian. And then he's got a T4 with the BC income here. So again, this is a relatively straightforward return. What the main focus here is to look at his Schedule 7, and we will look at that next time, as well as answering the questions. And you're going to need to determine if he needs to complete a T1135. All right. No spoilers, no spoilers. But we will review that at the beginning of next class. Okay, so on that note, then, for those of you online, we're going to break off here then. We will talk about 8-2 in our next session. So don't worry. It's a fairly straightforward problem, but we will touch on that briefly at the beginning of next class. All right, so for those of you listening online, that's all for now. I will see you next time, and we'll stop the recording there.